In every era, there is a moment the world misreads completely, a moment when everything looks stable on the surface. Yet beneath it, the foundations have already begun to shift, and the most dangerous part, no one notices it while it is happening. City skyline glows at night. Glass towers reflect the illusion of endless growth. Stock markets print record highs. Financial news anchors speak with calm confidence, as if the future has already been secured. Investors call it opportunity. Governments call it progress. Ordinary people call it normal. But normal is often the most deceptive phase of any cycle, because behind this surface of stability, something very different is taking place. In high-rise offices that never appear on television, in private wealth, rooms behind biometric doors, in institutions managing trillions of unseen capital, a quiet shift begins. It does not look dramatic. There are no alarms, no headlines, no public announcements. It is almost invisible, but it is decisive. The world continues to move toward risk, toward growth, speculation, and expansion. Yet the most powerful players in the system begin to move in the opposite direction. They are not chasing the next big opportunity. They are stepping away from it, silently, systematically, almost as if they are responding to a signal the rest of the world cannot hear. Billions begin to reposition not into innovation, not into hype, not into the assets that dominate public conversation, but into 5 categories that seem almost unremarkable compared to the excitement of the market. Cash reserves, gold, government bonds, defensive real estate, strategic commodities, and farmland. To most people, this behavior would appear irrational. Why step back when everything is rising? Why reduce exposure when the world is celebrating growth? Why move toward boring assets when risk appears to be paying off? But this is where the paradox begins to reveal itself, because history suggests something deeply unsettling. When the majority feels safest, the most informed participants begin preparing for instability, not after. It begins before it is visible, and this pattern is not new. It is not accidental. It is not isolated. It repeats across time like a hidden rhythm beneath economic history itself. The Great Depression, the inflation shocks of the 1970s, the dot-com collapse, the 2008 financial crisis, different eras, different causes, different technologies, but one behavior appears again and again. While public confidence reaches its peak, a quiet migration of capital begins, out of risk into safety. And this raises an uncomfortable question that most people never fully confront. How? Is it possible that those closest to information consistently behave in ways that contradict the world's optimism? Do they know something others don't? Or are they simply better at interpreting the same signals everyone sees but chooses to ignore? Because if you look closely, the warning signs are never completely hidden. They are just normalized. Debt levels that feel manageable. Asset bubbles described as new paradigms. Markets that feel different this time. Every cycle produces its own language of reassurance. And yet, beneath that language, the structure remains unchanged. Expansion over confidence. Leverage, fragility, until something breaks. And when it breaks, it always feels sudden to the majority. But to those watching deeper signals, it rarely is. It feels prepared. That this creates a disturbing possibility. What if economic crashes are not random shocks to the system at all? What if they are transitions? Predictable phases within a repeating structure of human behavior, credit expansion, and emotional cycles where the real advantage is not in reacting quickly, but in positioning quietly long before anything appears. Wrong. Because in every major financial cycle, one truth remains consistent. By the time the collapse is obvious, the positioning phase is already over, and the most powerful players are no longer preparing. They are already positioned, which leads to the most important question of all. If this pattern has repeated across centuries, across systems, across technologies, then what exactly are these 5 assets that consistently appear before every major shift? Are they simply defensive tools? Or are they something deeper, something closer to a map of how power behaves when the world transitions from stability into uncertainty? Because once you start noticing this pattern, you begin to see it everywhere. In calm markets that feel too confident, in rapid growth that feels too smooth, in optimism that feels too complete. And slowly, an unsettling realization begins to form. is not that crashes are unpredictable, it is that most people are only trained to see them after they begin. But by then, the positioning has already been done and the world has already changed. Hands dot silently, like it always does. History does not repeat itself in the way textbooks suggest. It does not move in neat cycles or clean patterns that are easy to recognize. In real time, instead, it behaves more like a shadow-shifting shape depending on where you stand, only becoming clear when the light has already changed. And in financial history, that shadow has a consistent outline. It always begins the same way, with confidence. In the late 1920s, the world was convinced it had reached a new level of economic intelligence. Industrial production was expanding, stock markets were rising, credit was flowing freely. Newspapers spoke of permanent prosperity, as if human innovation had finally eliminated the possibility of deep financial collapse. On the surface, everything looked rational, stable, optimized. But behind that confidence, something quieter was happening in private rooms, above the streets of New York, in banking offices where decisions were made far from public attention. Capital was already beginning to change direction. Not dramatically, not publicly, but deliberately. Liquidity started to increase in hidden accounts. Exposure to speculative assets began to reduce, and instead of chasing the excitement of rising markets, certain institutions began to increase their holdings in cash and gold. At the time, this behavior did not make sense to the outside world. Why? Step back from a booming market. Why reduce exposure when everything appears to be growing? But history would later reveal what was invisible in that moment. The boom was not a sign of strength. It was a sign of accumulation of risk building beneath the surface. And when the collapse arrived in 1929, it did not arrive as a mystery to everyone. It arrived as a confirmation, not for the majority, but for those who had already positioned themselves. The same pattern reappeared decades later. In the 1970s, the global economy entered a different kind of instability. This time, it was not a sudden crash in markets, but a slow erosion of purchasing power. Inflation began to rise. Energy prices surged. Confidence in traditional financial structures weakened to the public. It felt confusing, unpredictable, even irrational. But again, beneath the surface, capital was moving. Out of fixed promises, out of long-term financial instruments that depended on stable currency value, and into tangible, physical, and defensive forms of wealth. Commodities began to gain importance. Gold re-emerged as a critical store of value. Energy assets became central to global strategy, not because anyone predicted exact events, but because the structure of the system was signaling stress. And once again, those who understood the structure early were not reacting, they were repositioning. Then came a modern version of the same story in the years leading up to 2008. The global financial system appeared more sophisticated than ever. Financial engineering had created complex instruments designed to distribute risk. Housing markets were expanding, credit was abundant, confidence was high. From the outside, it looked like innovation had stabilized the system. But inside the system, something very different was forming. Debt was accumulating at layers that were increasingly difficult to see. Risk was being repackaged into instruments that appeared safe. And confidence was becoming detached from underlying reality. Yet again, capital, in its most informed form, began to behave differently. Exposure to the most fragile parts of the system was quietly reduced. Liquidity was increased. Defensive positioning began to rise. Not loudly, not publicly, but systematically. And when the collapse finally arrived, it did not feel sudden to everyone. For many, it felt inevitable. This is where the deeper paradox of history begins to emerge to the majority. Economic crashes feel like chaos, unexpected ruptures that break otherwise stable systems. But to those who study patterns of capital behavior, they often resemble something closer to weather systems. Not random, but cyclical. Pressure builds slowly. Indicators appear gradually. Signals emerge in sentiment, credit expansion, and behavior long before they appear in headlines. And yet, most people remain unaware until the final phase. Why? Because every economic era develops its own illusion of uniqueness. In 1929, it was Industrial Revolution, prosperity. In the 1970s, it was global inflation transition. In 2008, it was financial innovation. Each time, the story changes. But the structure does not. That separates perception from reality. The surface narrative evolves, but the underlying cycle remains. Constant expansion, euphoria, overconfidence, fragility, correction, again and again. The wealthy are not reacting to headlines. They are not reacting to narratives. They are reacting to structure. They are watching debt cycles expand. Liquidity conditions tighten, risk concentration increase, and sentiment detach from reality. And when these signals align, they do not predict the exact moment of collapse. They do something more important. They reposition before collapse becomes visible, which leads to a question that becomes increasingly difficult to ignore. If these patterns are so consistent across time, why does the majority continue to be surprised by them? The answer is not ignorance. It is timing, because by the time history becomes obvious, it is already in the past, and by the time the system reveals its stress, those who understood it early are no longer participants in it. They are positioned outside of it, observing it, waiting for it to complete its cycle, and preparing for what always comes next, not the collapse itself, but the transfer that follows it. To understand why certain assets consistently appear before every economic collapse, you have to stop looking at markets as if they are random movements of price, and start looking at them as a system, a structure, a machine that runs on invisible fuel-confidence. At its core, the global financial system is not built on money alone. It is built on trust in future. Money.debt today is repaid by income tomorrow. Valuations today are justified by expectations of growth tomorrow. Every layer of the system is essentially a bet on continuity, and when continuity is believed, the system expands. Credit flows easily, risk is rewarded. Borrowing increases. Asset prices rise not necessarily because value is increasing, but because confidence is multiplying. This is the expansion phase. It feels like progress, but structurally, it is accumulation. Accumulation of leverage, accumulation of exposure, accumulation of hidden fragility. And this is where the first illusion forms. Because the system does not feel fragile during expansion, it feels powerful, almost unstoppable. But underneath that feeling, something very different is happening. Every loan created increases future obligation. Every asset inflated increases future vulnerability. Every period of optimism builds pressure that must eventually be released. Not because of external shock, but because of internal mathematics. And this is where the mechanics of collapse begin to take shape. The global economy operates like a complex hydraulic system. Liquidity flows through banks, institutions, governments, and markets like water through interconnected pipes. When confidence is high, pressure increases gradually across the system. Water flows freely. Every part of the system appears functional. But when confidence breaks, something immediate happens. The flow reverses, and liquidity does not slowly decline. It disappears instantly, like a valve shutting off. Oxygen in a sealed environment. This is the moment most participants in the system are never prepared for. Because in normal conditions, liquidity feels permanent. But in stressed conditions, it reveals its true nature. It is conditional, dependent entirely on trust, and trust, unlike physical resources, can vanish without warning. This is where the 5 key assets begin to emerge, not as random investment choices, but as structural responses to system stress. Each one plays a different role within the collapse mechanics of the system. Cash represents liquidity itself. Not growth, not return, but immediate optionality. In moments of panic, cash becomes the ability to act when others cannot. Gold represents something deeper. It is not tied to any system of debt or government promise. It becomes relevant when trust in paper systems begins to weaken. Government bonds represent structured safety within the system itself. When fear increases, capital often flows into sovereign debt. As a temporary refuge, assuming the issuing authority remains credible. Defensive real estate represents anchored income, not speculative value, but real-world cash flow that continues even during instability. And commodities or farmland represent physical reality, production, scarcity, the base layer of economic existence that remains when financial abstraction becomes unstable. At first glance, these appear to be conservative strategies, but structurally, they are something else entirely. They are survival positions within a system designed for expansion, not contraction. And this creates a paradox that most people never fully understand. The financial system is designed to reward risk-taking during expansion, but it is designed to reward liquidity during contraction, which means different participants are rewarded in different phases. In expansion, those who take leverage and exposure appear successful. In contraction, those who hold liquidity and defensive assets gain power. And this is where the system reveals something uncomfortable. It does not reward intelligence in a linear way. It rewards timing relative to cycles. Because the same asset that looks boring in a boom becomes powerful in a crisis. And the same asset that looks powerful in a boom becomes dangerous in a crisis. This is why crashes are not system failures. They are system resets. They are moments where accumulated imbalance is released through price movement. And in that release, wealth does not disappear evenly. It redistributes. From forced sellers to prepared buyers, from those who must exit to those who can choose to enter. And this is where the deeper mechanics become visible. The wealthy are not trying to avoid the system. They are positioning themselves within its structure in a way that allows them to benefit from both phases. During expansion, they participate selectively. During contraction, they deploy accumulated liquidity. This is not prediction. It is positioning logic, because the system itself creates predictable emotional cycles. Euphoria leads to overconfidence. Overconfidence leads to leverage. Leverage leads to fragility. Fragility leads to panic. Panic leads to forced liquidation. And forced liquidation leads to opportunity. Concentration every single time. This is why the illusion of unpredictability exists, because while the structure is consistent, human behavior is not. And it is human behavior that creates the timing of collapse, not the system itself. The system only defines the boundaries. Humans define the movement within it. And this brings us to one of the most important insights hidden inside financial history. Crashes are not moments where value disappears. They are moments where value changes hands, quietly, changes hands, quietly, rapidly, inevitably, and the 5 assets exist. Precisely because they behave differently across these phases. They are not dependent on the same emotional structure as speculative assets. They do not rely on optimism. They rely on continuity, and continuity is what becomes uncertain during stress, which leads to a deeper realization. The system does not break randomly. It breaks when expectations move too far ahead of reality, when promises exceed capacity, when leverage exceeds stability, when belief exceeds structure. And at that moment, the system corrects itself, not emotionally, mathematically. Which means that every expansion phase contains the blueprint of its own contraction, hidden in plain sight. And those who understand this do not try to escape the system. They simply adjust their position relative to its phases. Because in a system driven by cycles, survival is not about prediction. It is about alignment, and alignment, in financial history, has always revolved around the same principle, knowing when to hold risk, and knowing when to hold safety, not after the change happens, but before it becomes obvious to everyone else at some point in financial history. The illusion of separation between countries quietly disappeared. Nations still have borders. Currencies still have names. Governments still make independent decisions. But beneath all of that, something far more powerful emerged. A single interconnected system of capital flows that ignores geography entirely. And in that system, distance does not matter. Only liquidity does. To understand how wealth behaves before economic collapse, you have to stop thinking in terms of countries and start thinking in terms of networks. Invisible networks of money, trust, and fear that move across the globe in real time. Picture the world not as a map of nations, but as a living circuit: New York, London, Frankfurt, Hong Kong, Tokyo, Dubai, Singapore, each one a node. Each one connected, not by politics, but by capital. And in calm conditions, this network appears stable. Money flows predictably. Trade balances adjust. Investments expand across borders. Everything feels structured, controlled, almost engineered for efficiency.